Hey, what's up, guys? This is Angel. I'm happy to bring you guys a class today specifically on the bearish and bullish engulfing candle patterns. All right, well, I hope you guys are ready to embark on this journey, as this is one of the most important and crucial pieces of information that you could take for trading. Hey, what's up, guys? Before we dive into the world of candlestick patterns, it's essential to understand the very foundation, the candlestick itself. Think of it as your trading compass, a tool that will help you navigate the unpredictable waters of the financial markets. Each candlestick is a visual representation of price movement over a specific time frame. It has four crucial components that tell a story: the open, the close, the high, and the low. Imagine a candlestick as a mini movie where these components play distinct roles. The open and close, where the open is where the candlestick begins its journey, the price at which the market opened during that specific time frame. The close, on the other hand, marks the end of the cinematic journey and its price at which the market closed during that same time frame. Now let's talk about the high and the low, which are extremes in our mini movies. The high represents the highest price reached during the candlestick's performance. It's like the soaring climax of the story. Conversely, the low stands for the lowest price experienced within that time frame, the nadir, or the most challenging moment for our characters. To make it simple, think of the candlestick as a story. The open and the close are the beginning and the end. The high is the most exciting part, and the low is the most challenging moment. Now these four components come together to form a candlestick, and this is where the magic happens. Understanding the interaction between these elements is your key to unlocking the mysteries of market sentiment. Whether you're dealing with minutes, hours, or days, the language of candlesticks remains the same. It is your cipher to decode price dynamics and is the foundation upon which we'll build our understanding of candlestick patterns. These patterns are the building blocks of technical analysis, and they carry a reputation for their simplicity and profitability. Candlestick patterns are not just another tool in the trader's toolbox. They are like the North Star, guiding your ship through the vast ocean of financial markets. Research has validated their high predictive value. They are, in essence, the treasure maps of the trading world, leading you to profitable opportunities. Think of candlestick patterns as a language of the market, your passport to understanding the intricate foreign land of trading. Just as in a foreign country, if you can't communicate, you're at a significant disadvantage. Mastering this language enables you to interpret what the market is saying. It's akin to learning local customs and traditions, allowing you to anticipate how the market will behave. In essence, learning how to read candlestick patterns correctly is like acquiring fluency in the market's dialect. It reveals the hidden nuances of the market's dynamics and unravels the mysteries of traders' behaviors. This is the moment where the world of trading is going to open up to you. These patterns are not just mere shapes on a chart. They are the keys to unlocking the market insight. And today, we're going to embark on that journey, and we're going to get into the engulfing candlestick patterns. And as a reminder, we're always looking at the high time frames. People, we want big money, not little money. To the mesmerizing realm of the engulfing bar. Picture this pattern as a colossal wave that completely engulfs the previous candle. It's like the hero of our trading story, asserting his presence boldly on the chart. An engulfing bar can be so formidable that it doesn't settle for just one previous candle. It can devour more. However, to be officially recognized as an engulfing bar, it must at least consume one full candle. Now, why are we particularly intrigued by the bearish engulfing? Is because the pattern serves as a powerful sentinel in the world of trading, signaling significant shifts in the market dynamic. But let's dive deeper. The engulfing pattern is a tale of two bodies, one modest in size, followed by a larger one that swallows it whole. It's like a scene in a play where the villain takes over the spotlight. When this bearish engulfing pattern emerges, it serves as an announcement. Sellers have seized the reins of the market. They're asserting their dominance, and this can have substantial consequences for the buyers who are trying to hold. The most remarkable aspect is when it unfolds at the end of an uptrend. It's like the climax of a thriller. The heroes, the buyers, are overshadowed by the emerging power of the villains, the sellers, signifying a potential reversal in the storyline. Let's head on to the next screen and check out some live chart representations of the bearish engulfing candlestick pattern. Let's go! And as we can see in this chart, the market is in an uptrend. So it's just going up and up and up, we're tracing down and continuing up until we see this bearish engulfing candlestick that is humongous, engulfs multiple days of data. We know at that point that would be a good sell position. If we were in a buy position, we'd close all those buys out, put a sell in, put our stop loss right above that top of that engulfing candlestick, and we would let it ride until we saw an indication of a reversal, which we see down here. Would have closed out at 1.11960, totaling up 5,000 pips or more. That would have been a beautiful day. And that is the bearish engulfing candlestick. Now, the bullish engulfing pattern is a more optimistic narrative. It's like the sun breaking through the clouds after a storm, bringing hope and clarity. This pattern consists of two candlesticks as well. The first is like an opening act, setting the stage. Our second, the engulfing candle, burst into the scene with fever, completely engulfing its predecessor. The moment signifies a transition from seller's control to buyer's dominance. It's like the pendulum of the market is swinging in a new direction, from despair to hope. During an uptrend, it is a signal of a continuation, as if the market is saying, carry on, the trend is strong. But when it surfaces at the end of a downtrend, it's like the phoenix rising from the ashes, foretelling a powerful trend reversal or a fresh start for our characters. Those two engulfing patterns are like the climax or turning points in the stories told by the candlesticks. They reveal a shift in power dynamics, whether it's sellers overpowering buyers or buyers staging a comeback. Here we are on the weekly chart in a downtrend. And we see it makes a bullish engulfing candlestick here at 1.04960. And it goes up from there. That's how easy this is. So find that in the weekly or the daily, and you're in there. Now you've grasped the essence of candlestick patterns and their significance. But remember, trading isn't a one-man show. To make well-informed decisions, you need to consider additional factors of confluence. These are like supporting actors, providing context and depth to your trading decisions. One such factor is the use of moving averages. They play a dynamic role as both support and resistance levels. Imagine moving averages as the rhythm of your trading journey, setting the tempo. Moving averages smooth out the market's erratic movements and create a steady beat. When candlestick patterns align with a moving average, it's like the harmony of two instruments in a symphony. This harmony strengthens your conviction in a trade. Another one is support and resistance, especially in the higher time frames. These levels are like the backbones of the market, defining critical zones. When you spot a bullish or bearish engulfing pattern aligning with a support or resistance level in a higher time frame, it is as if the entire orchestra is playing in harmony. This adds an extra layer of conviction to your trade. Remember, trading is a multifaceted art. By incorporating these additional factors, you're stacking the odds in your favor. You're not just reading the lines in a script, you're understanding the nuances, the subtext, and the underlying themes. So while candlestick patterns like the engulfing bar are powerful on their own, when combined with moving averages, support and resistance levels, and the context of higher time frames, they become even more formidable tools in your trading arsenal. Sweet. All right, because all it is just we're going to take this time. Each of these videos will be about one specific candlestick pattern, all right? So that it makes it easy for you to just go in and learn one at a time so you're not overwhelmed by an entire hour and 40 minutes of a class. Now, let's recap the key takeaways. You learned that engulfing patterns, both bullish and bearish, are powerful tools in trading. Bearish engulfing patterns at the end of an uptrend signal potential reversal, while bullish engulfing patterns in an uptrend indicate continuation, and at the end of a downtrend, they serve as strong reversal signals. But remember, trading is an art that requires practice. These patterns are your brushes and color. You need to develop the skill to paint on the canvas of the market. It's not about quick wins, but about honing your abilities over time. All right? Engulfing patterns are your guiding stars in the complex world of trading. They are the chapters of your trading story, revealing crucial plot points and dramatic twists. I encourage you to keep learning, keep practicing, and keep developing your skills. Your journey doesn't end here. This is just the beginning. The more you immerse yourself in this world, the more fluent you become in the language of the market, the easier it will be. Take the knowledge you've gained today, apply it, and continue to refine your craft. I look forward to seeing each of you evolve into a successful trader. Thank you for joining me today, Titans, and until our next class, keep those candles burning bright.